right, let's talk a little loan lingo here because there's a lot of acronyms in mortgage. There's a lot of abbreviations, and there's a lot of stuff that people that are in the industry throw around. And you're talking to a first-time home buyer, and they're like, "I've never heard what that is before in my life."
Yeah.
Can you go through some of the common loan terms that they're going to be seeing and hearing, and what those all are and what they mean to them?
Yeah, sure. So most of the time, a lot of people are asking for, hey, what's your loan estimate? What's your good faith estimate? People will say that what that is it's an actual document that by law, every mortgage company has to use the same format. And it breaks down just the details of your loan. So it's going to break down total monthly payment, how much is your PMI, how much is your taxes, how much is your insurance, and then it's going to also break down all the closing costs. So it's a very important document that you want to have if you're comparing lenders, because some lenders will have more costs than others. Some will have higher rates than others, higher APRs. And so I'll just cover that one real quick. APR is basically the interest rate plus the cost, and they kind of do an average of that. So if you take all the interest of the loan plus the cost they're charging you up front, then it creates the APR. So you can kind of judge between people. If someone's giving you a 7 APR and another one's giving you a 6.5 APR, well, the 6.5 is probably a better deal. But you have to kind of look at all the factors. So APR, like I said, that's annual percentage rate. That's different than just the interest rate on the loan because it takes into account the closing costs.
Yeah, the fees. Yeah,
right.
Makes sense.
Interest rate, that's just the rate that you're paying per year. So if it's a $100,000 loan, just simple math here, $100,000 loan, 6% of that, what is that? $6,000 in interest for the whole year. That's kind of how the math works. So that's the amount of interest. That won't necessarily be the amount that your payment is. So you really just kind of look at how much is going towards principal, how much is going towards interest, and then different terms as far as, a 15-year versus a 30-year. Those are going to have different breakdowns for those.
What is principal?
Principal is the amount of your payment that's going towards paying the balance down. So let's say you have a $2,000 payment, $400 is going to principal, $1,600 is going to interest. Well, your balance is going to go down by $400 that month. That's basically how it works.
That makes sense. And then what about escrow?
Escrow, think of it this way. Escrow is a savings account that the bank holds for you. That every month when you make your payment, a portion of that goes in for taxes and a portion goes in for insurance. And then when the tax bill comes due, they pull it out of that account and pay it. When the insurance bill comes due, they pull it out of that account and pay it. That's the easiest way to think of it. Escrow account is just a savings account to pay your taxes and your insurance.
It's like a holding tank for my future bills, basically.
Yes.
Okay. And then rounding out, so we've covered interest, we covered principal, we covered escrow. This is the last piece that could be a component of your payment. What is mortgage insurance?
Yes. So mortgage insurance is a fee that the bank is going to charge if you don't have 20% equity. It basically insures them in the event that you default on the loan. Because if you default on a loan and there's no equity in the house, the bank's going to lose a lot of money. So they have to have an insurance policy there.
That makes sense. What about discount points?
This is a big one that everyone should really pay attention to. Discount points it's a fee the bank is charging you to get the interest rate that you're getting. So there could be 0 discount points. For example, right now in today's market, you might be able to get a 6.5% where they don't charge you any discount points.
Because a point is a percentage of the loan amount. So 1 point would be 1% of my loan amount.
Yes, but Here's where people get confused. Some people think if I pay 1% of my loan amount in points, my rate's going to go down by 1%.
Right.
And that's not how it works. So it's very it's actually very hard to explain, that in that way. But the cost of the point is one thing. How much it lowers your rate is another thing.
Yeah.
So in today's market, for example, 6.5%, 0 points. Let's say I pay 1 point, so that's 1% of the loan amount is what it costs. It might only lower my rate to 6.125 instead of 6.5.
Yeah, and just another caution for first-time home buyers is not every lender's rates are the same. So lenders have different strategies and they charge different, it's called margins to their customers, but it's how much are they trying to make on the back end of your loan, and that will affect that rate sheet. So if we have 6.5 available at no points, a competitor down the road might be offering 6.5 with a full point. Like you might be paying for that same rate. So
Right.
just understanding what you're getting is good.
Yeah, so you just have to pay attention to how much is this rate costing me. Like to make it simple for everybody, that's what you have to pay attention to.
All right, last one that's the major one for this topic is give me the difference between a fixed rate and an adjustable rate.
Yeah, so fixed rate, pretty easy to understand, I think, is let's say it's a 30-year loan. That means that rate is the same for the whole 30 years. It never changes. So your principal and interest payment will never change. Things that could change is if your property taxes go up or your homeowner's insurance policy gets more expensive. Those are things we can't control, but the 30-year fix means it's fixed. So you could have a 30, 25, 20, or a 15-year. That rate won't change for that entire term. Now, an adjustable rate mortgage is going to be adjustable for a certain period of, it'll be fixed for a certain period of time. So for instance, a 5/1 ARM, adjustable rate mortgage, that's what ARM means, is fixed for 5 years. And then after it, the second number 1 means every year it can adjust one time. So your payment could change every year after that first 5-year period. So most people opt for fixed rates. They don't like the idea of things changing in the future. But if you ever want to look at an ARM, adjustable rate mortgage, just know that it's only fixed for a portion of time.